Hi folks, and welcome to Module 9.3, where we're going to talk about some of the bank internal controls, in particular bank reconciliations, and how we deal with our bank account in an organization. So first off, as we've learned about in the internal controls part of this chapter, this module, the use of a bank account can minimize risk to an organization because, again, we don't have to keep as much cash on hand. Again, cash is typically a higher risk to hold around, as it's easy to steal or fall into the wrong hands. So we use a bank for depository, so we can make deposits of cash. We can write checks or receive checks from customers in order to pay without having to hand cash back and forth. We also provide a second record of our transactions. So not only do we keep a record of it, but the bank has a record of this as well, so we can ensure that things are in line. We're going to look at some differences between the records that we might have inside of our company and what the bank might have in terms of the bank statement. So there are a couple of different reasons why we might have different records. The first could be time lags. So for example, if you own a bank account and you receive your statement, there's a couple of things that might come in. You may have written a check to someone that they haven't gone out and cashed yet. So you know that that money is spent, but the bank doesn't know yet. And so you know, your two balances in your mind, what you think you have and what the bank says you have, may be a little bit off. Or there also might be some transactions that just haven't been recorded on either side. For example, if mom or dad or uncle or aunt has deposited money into your account without you knowing, again, you might think you have $100 in your account and mom or dad has deposited an extra $500. You won't necessarily know that until you actually go and check your bank statement, and then you'd be brought aware of that. So we could also have some errors on either side that might create a difference. And so what we do is we create what we call a bank reconciliation, where we try to make sure that both our bank balance as per our bank statement and the balance in our cash account sort of agree. So we account for the differences in timing or adjustments for transactions that one or the other just didn't have correct or didn't know about. So bank reconciliation, fairly straightforward. We're going to start off by looking at adjustments on the bank side. So we start with the bank statement and the amount that they have. We're going to adjust anything that they don't know about. So we're going to add what we call deposits in transit. So this is a deposit that we've made that just hasn't made it to the bank yet. So we know it's in our account, but the bank hasn't received the deposit yet. So we need to tell the bank that our account is increased by these deposits. We may also have some outstanding checks. So the bank doesn't know that these checks are out there. The people that we've written the checks haven't gone to cash them yet. But when they do, it's going to decrease our bank balance. And so we need to let the bank know, or we need to adjust the bank statement based on those outstanding checks. And last could be bank errors. So again, that might be a positive or negative error. Perhaps we made a deposit of $100 and the bank had put it in our account as $1,000. So we would want to adjust for errors. And they could be either up or down. Then we have our own company book. So this would be the actual ledger account called cash. And we may need to do some adjustments based on information we receive from our bank statement. So we could have what we call electronic funds transfers or other deposits. So maybe a customer went into our bank and deposited money that they owed us, and they didn't tell us. And so that would mean that we have to increase our own records to say such and such customer has given us money, and so our cash account is going up. We may have service charge or other payments. So again, we might not know what our service charges are until we get our bank statement. We may also have interest that's been earned. So if the bank paid us interest, we might not know about that until we receive our statement. And so we'd want to record an increase in our cash based on interest. Or there might be some errors that we've made that our bank statement will help us to rectify. So we're going to walk through a sample bank reconciliation in just a moment. But basically, we're always going to start with items for the bank. We're going to add our deposits in transit and subtract our outstanding checks and add or subtract any of our bank errors. Reconciling the books, again, we're going to add any deposits we don't know about, subtract any other payments, service charges, etc., and look at book errors. So I'm going to jump to our example here. So let's look at a bank reconciliation for Neapolitan Limited for July. We have the following transactions. So we have cash balance as per the bank. We have the book balance as per the company records. And we have a number of different transactions that have come to light. So just like any statement, we're going to start off with our title, Neapolitan Limited, Bank Reconciliation, and it's as at a specific date, July 31st. We'll start on the left-hand side with balance per bank, and we'll put the balance there, $88.33. And on the right-hand side, balance per books. And we're going to go over here to $71.90. Okay, again, we're going to add any deposits in transit. And over here we've got, number 3 says we have bank service charges. So the bank knows about the service charges. We didn't. And so we need to record that cost on our books. So we're going to reduce our cash balance by bank service fees. We have some deposits in transit of $15.75 that the bank hasn't received yet, so we should increase our balance as per the bank for those deposits in transit. Number 5 says we had an electronic receipt from customer in payment of their accounts. So again, they went directly to the bank to pay. They didn't tell us. So increase electronic funds transfer from customer for $883. We have some outstanding checks. So again, we've written the checks. As soon as we write the check, we've reduced our cash account, but the bank hasn't received them yet. So we're going to subtract outstanding checks of $24.49. And we had check number 373 correctly written and recorded by the company as $672, but the bank has deducted $762 from the company's account in error. So anytime we have an error, I like to do a couple of things. I like to first rectify the error. So when the bank deducted $762, we should first reverse the error. So when the bank deducted it, we should put it back in, $762. And 2, we'll put the correct amount. So it should have been $672. And it's a check, so it would reduce our balance from the bank. Okay, so those are the transactions we have for this example. Let's take a look at what we've got in terms of our balance. So $88.33 plus $15.75 minus $2,449 plus $762 minus $672 means we have a bank balance of $8,049. That's the same on both sides, and we're going to call this our adjusted balance. Okay, so that's our adjusted balance. So after everything has been taken into consideration. The next thing I want to look at is just looking at another generic bank reconciliation. Let's take a look at how this all comes to order. So let's talk about all the different options that we have here. So balance as per bank, balance as per books. We'd put the amounts here. Again, we'd add any outstanding checks. Add any deposits in transit. Subtract any outstanding checks. And add or subtract any bank errors. On the balance per books, we should add any electronic fund transfer from customers. We should add any interest earned. We should subtract any bank fees. We should also subtract any NSF checks received by customers. So what this basically means is the customer has paid us but didn't have the funds. And so what we've done here is when they gave us the check, we removed our account receivable and increased our cash account. And we later find out on our bank statement that they never had the money. And so they still owe us the money. We should then reduce our cash balance and reestablish the liability or the asset of account receivable. The customer owes us that money still. And then we'd add or subtract any company errors. Okay. The other element to remember here is that as we're looking at these transactions, any adjustments that we make here need to be adjusted in the books. We need to make our cash account rectified. So we can't just say our new balance is this is our adjusted balance. We also need to ensure that our actual cash account, if we looked at our T account, that our cash account actually shows these things. So let's look at the different transactions that would occur for each of these transactions. So the first one, an electronic funds transfer from customer. So when we have an electronic funds transfer from customer, what's really happening is our cash is going up, and we're going to remove an account receivable for their customer. They went directly into the bank. They no longer owe us the money. So that would be our adjusting entry for the first adjustment. For interest earned, again, our cash balance is going to be increased, and we're going to credit what we call interest earned or interest revenue, depending how we categorize it in our company. The third one will be bank fees. So again, in this case, we're going to recognize an expense called bank fee expense and reduce our cash balance. Number 4 is that NSF check from a customer. Non-sufficient funds. So again, the customer owes us the money again. We need to reset up our account receivable and reduce our cash balance because they never really actually paid us. And last but not least would be company errors. And again, company errors, we should reverse the initial entry and post the correct one. So let's take a look at an example of a company error. ABC Company wrote a check for the proper amount of $320 to add it for advertising. the bookkeeper recorded this transaction as 302 in the general journal in error. Upon receipt of the bank statement, we noticed the error and want to correct it. Okay, so again, in this case, the best thing to think about is, let's think about the initial journal entry. So in this case, we would have, at the time, had a debit to advertising expense listed as 302 and cash listed as 302. And this, of course, we know is wrong. So we should reverse the transaction. So just do the exact opposite. Cash 302, add expense 302. So now everything has been brought back to 0. The second step would be post the correct transaction. So again, here we'd have add expense now for 320 and decrease our cash account for 320. So that's how we would deal with a company error. Reverse the transaction that was incorrect and post the correct transaction for the correct amount. All right, folks, so that's lecture 9.3, primarily dealing with bank reconciliations. Again, continue to work through your self-assessments and join me at the live tutorial on Thursday evening, and we can work through a couple more examples. Thanks so much and have a great day.